the Thursday edition of the Not Your Average Investor Show, the JWB Rental Like a Week. I'm your host, Pablo Gonzalez, and with me today is a world-renowned real estate educator. He's been investing in rental properties across the U.S. and other forms of assets for many, many years, and friend of the show. He's been on before. He was requested back because of the value he brings. He is John Blackburn. Welcome to the show, my friend.
Thank you, sir. This is going to be fantastic. Excited for it. And as always, it's a privilege and a pleasure to be on here.
Yeah, man, it's a privilege and a pleasure to have you. And as always, we have our community manager in the house. We call her MTM because she brings us the moments that matter and because her name is Madison the Magnificent. Say hello, Madison.
Hello, everybody.
And as we like to say, if you are listening to us on the podcast here in the future or watching live on YouTube, we love having you. We love having your attention, but you would love joining us live one of these days. Just go to nyais.com, be part of the fun. We got an active community here and get to ask your own question and meet fascinating people like John and Madison and GC and be part of a little tradition that we call the roll call. You ready for the roll call, John?
Let's go.
Let's go. We got the ringmaster of the Not Your Average Investor Show community checking in first. Drew Barnhill saying good afternoon. We got our usual leadoff batter hitting second here. John Henning saying good afternoon, saying, hey, John, to you, John. I think that's a name y'all share. So
he's one of my students.
Oh, there you go. There you go. Love that. We got Lee Bishop. He's the MVP of the Not Your Average Investor Show community. So, of course, he's batting third and batting cleanup. Aaron O'Neill into the lights. Good to have you back, Aaron. Love to say your name on this chat. We got Hervé Francois from New Jersey with saying, what up, JWB fam? Good to have you in the house, Hervé. We got Leo Faraganan. That's how we pronounce his name around here. John, in case you're wondering, he's saying good morning all the way from Bay Area, California. It's time to rock this show. We got the fairy godmother of the Not Your Average Investor Show community, Jen Filson, in the house saying hello, JWB family from lovely Monterey, California. We got the patriarch and the matriarch of the first family of the Not Your Average Investor Show community, Ken and Carolyn Moline checking in. We salute you, Ken and Carolyn. We got the man that everybody knows, Noah Randari, checking in from California. Good to have you back, Noah. We got the early bird, the guy that shows up first to the IRL meetups, Dean Curry from Columbus, Ohio. Dean in the house. Good to have you, buddy. Who else we got? Scrolling through here. Love the community checking in. Wendy Hurst. Wendy, I think this is first time on the show, maybe. Wendy, happy to have you. Love making it a tradition. Yes, Lee, I'm not in the office. That's going to be in the breaking news, what I'm doing today. But before we get to the breaking news, we get to my favorite segment of the week, which is Madison shares good news. Give us some good news, Madison.
All right, everybody. This is my favorite news to share. I'm sure you all have kind of caught on. It is the contributions that new and existing clients make to a foundation that is near and dear to my heart, JWB Cares. In the last 2 weeks, we have had $600 donated from you all to the JWB Cares Foundation from new and existing clients putting more homes under contract. If you don't know, you're about to know. When you put a house under contract, you have the option to donate to JWB Cares and it just gets added onto your closing costs. So super easy way for you to give back to the community, for us to give back to the community. I want to give a special shout out to Ruben and Wendy. I'm not sure if they're on this show, but they've been on it before. They contributed $300 out of that $600 to the fund within the last few weeks. And a super big congratulations to them for also putting 3 new homes under contract. In JWB, we have a core value called you're either growing or dying. So congratulations, Ruben and Wendy, for growing and continuing to work towards your passive investment goals. So that's all I got for you today.
Oh, man, that is the best type of good news. People giving to JWB Cares, people growing their investments. That is what I like to call good news. Love that, Madison. Thank you so much.
Of course.
And we got breaking news today. We are live from Las Vegas for the Fortune Builders Ignite Conference. GC, me, and some of the rest of the JWB team are out here. Louis Hudnell from Milipitas, California. I didn't get to say your name out there. I heard that you're coming, man. Hit me up. Would love to grab lunch. If you're here for that conference right now, I'm in the house. Go into that Hova app that they have. Meet up with me. Let's grab some lunch. Let's grab some dinner. Greg and I are speaking tomorrow, I believe at 3:30, we're talking about rental income property investing, and we're super, super pumped for that. But for right now, something I'm really pumped is to have this studly looking gentleman back in the house. John Blackburn, second time on the show, man. Pumped to have you here. Why don't you, before we get into the property of the week, why don't we give a little background about you, man? Tell us a little bit about your investing acumen and the stuff that you're teaching these days.
Yeah, absolutely. As I said before, thanks for having me back. I'm going to be old hat here after a few more times, but for me specifically, I've been investing for 17 years. I'm surprised I still have all my hair after all that stress, but we made it work. And just kind of like numbers to share experience more than anything is in those 17 years, probably bought and sold somewhere in a ballpark about 2,700 properties. I do multiple things. My passion is rental real estate. So that's my main focus for my own personal investing. That's my main focus for all of the coaching that I do. But at the same time, I also have an active real estate business where I do wholesales and flips. And I also do the BRRRR strategy as well as turnkey rental property investing in several states around the United States. So that's the game plan. That's what I do on a daily basis: live, eat, breathe real estate.
Love that. And you got you're also teaching it, right? You're teaching it online. You got this program and you got a group and like a kind of like coaching plus some online education. Tell us a little bit about that, man.
Yeah, so I have an education program called Rental Property Pro. The whole specifics around it is designed to help people buy rental properties, not wholesale, not do retail flips, just buy rental properties. We're coming into a time in the market where we're going to start to see the availability of properties and deals and numbers that we haven't seen in literally a decade and a half. So I'm super excited for my existing students and for new students, because they're going to have the ability to take advantage of a market that is prime for getting great deals and great returns. And I run a free group on Facebook called Rental Property Pro Master BRRRR Investing. I encourage you guys to come. I do a lot of live talks just like this, as well as add a lot of value in that group, give away a lot of free stuff, and then obviously do my coaching, which is designed to do one thing. And I know John's on here. He's one of my students. He just put his first rental property under contract that he's buying through his own resource of finding it, evaluating it, and grabbing it. And the goal is to do that within 90 days of the program. And he hit that mark for sure. So that's awesome.
Let's go, John. I love that, man. I love hearing about that stuff, right? Because we only get to, we talk a lot about the passive side on this show, right? So today we're gonna open it up, right? We're gonna talk passive. We're gonna talk about this JWB rental income property of the week. But I want you to take advantage of the fact that we have an expert here like John that has been doing it for 17 years, that is teaching people how to do it for themselves. So any like objective advice that you want from John, I like these days that, don't tell Gregg this, right? But I like these days where Gregg isn't here, because then we can, it's like the inmates running the asylum. We don't work for JWB. We're willing to give whatever advice you want. And I find that we get really, really good engagement from the community. So
yeah.
I'm just going to encourage that today. Take advantage of having John here. Use that Q&A function. Get your questions answered. But for right now, John, I'm going to whisk us away here magically to 2833 Robert Street, Jacksonville, Florida, 32207. Purchase price of $260,000. We got monthly rent of $1,587. It's a 3-bedroom, 2-bathroom, 1,200 square foot house. Construction status about 30 to 45 days out. It's going to have a 2 to 3 year lease, an annual appreciation rate of what we like to talk about, this like best in class appreciation rate for cash flow markets here in Jacksonville of 4.6%. And then of course, what JWB investors come for, right? What you should be investing in properties for, this IRR piece, right? This estimated return on investment in 10 years of 11.2%. And as you know, normally we go to what GC loves about this property. He's not here, but you all know that GC is a very prepared gentleman. So he let me know here to read it out. GC loves 3 things that you should be looking for as an investor right now. Does this investment beat inflation? We're in inflationary times. Having money under the mattress or having money in something that isn't beating inflation is reducing your spending power. It's reducing your active wealth. Yes, it is beating that. Does this thing mitigate risk? We talk about cash flow as risk mitigation here in the Natural Average Investor Show. This thing is cash flow positive. meaning that your risk is mitigated. It allows for those 5 profit centers to keep hitting. And is it passive? Yes, it is 100% passive because you've got a vertically integrated turnkey provider here with JWB that handles everything from you soup to nuts. And at the end of the day, right now, I don't know about you, John, but we're spending a lot of time looking at these investments, not so much as what it was last year or 2 years or 5 years ago or 10 years ago. We're looking at it as you've got money. What are you going to put your money into, right? Like, can you,
100%.
the financial advisors out there, you're reading all these headlines of just like, take your money out of the market and sit on cash or like buy a bond or something like that. But we really believe that if you're sitting under, if you are putting it under the mattress right now, you're losing money because of inflation. If you're buying bonds right now, you're losing money because they're not keeping up with inflation. So if you are in this buy and hold period, you've got this like 20-year market cycle outlook, this is the asset class to put it in, and this home represents an attractive investment. John, what do you when you're looking at something like this, what are you thinking about?
Yeah, can I share a quick story that I think will apply super awesome to this property?
You may.
Perfect. So there's an investor out there. His name's Ray Dalio. If any of you have heard of him, he's the most successful investor in the history of the world. And Ray Dalio back in the 80s got, taken the lunch, in terms of his investment portfolio because he didn't time the market correctly. And he asked himself this question. He's like, just because it hasn't happened in my lifetime, does that mean it hasn't ever happened? And he was wondering if that scenario that he ran into where he lost his money, did that happen previously in history? And what he did is he became more wealthy and wealthier is he put a team together. And what that team did is they took every trade that was ever made in the US stock market, they put it into a computer, put it into an algorithm. Basically what that told him, or what he realized, was everything that is going to happen in the future has already happened in the past, right? You could see these moments in time and these indicators occur over and over and over in time, right? And, that's what's allowed him to be so successful. And, I love that story because it's so true. We as human beings struggle to learn from our past, and we usually recommit the same sins over and over again when it comes to investing. But let's, how does that apply to this property and this piece of real estate? One thing we've learned in history with real estate is the best time to invest is yesterday. And let's kind of talk through that. Well, John, property prices are falling, interest rates are highest they've ever been, like, the sky is falling type situation. So let's put that into perspective, right? And I had talked about this with you, Pablo, a little bit before the call is, picture and imagine, right? It's 2010 and you just bought a house in 2006, right? You are pissed, right? You're like, oh my God, like I overpaid for this thing. It's worth $150,000 less than what I paid for it. Like, this is just the worst investment I ever made, right? Now, fast forward to 2022, right? You're looking back and you're kicking yourself 2 or 3 times because why? Because you didn't buy that house in 2006, right? That house is a steal, right? 20 years later, or 15 years later, right? And same concept applies here, guys, right? Is, if you want to buy this thing and your plan is to sell it and make $1 million in 2 years, guess what? Not gonna happen, right? But if you allow real estate to do what it does best, and that's win over time. Real estate's a tortoise, right? As long as you can hold on to that tortoise for 10, 20, 30 years, there's a 99.9% chance that you cannot lose, right? So if it's beating inflation, right? If it's not an alligator, meaning it's giving us cash flow and not eating us alive, and so you're in a position where you can leverage it, right? Short the dollar, right? And hold it for 20 years, man, there's really hardly any way you can lose, to be honest with you.
Man, you hit on so many things that hit so close to home for me. For one, it's this idea that history repeats itself. And I feel like I feel lucky that getting to host this show, right? Coming in as a novice and getting to share the stage with guys like you and guys like Gregg and other great investors like Jen and the rest of our community here. I've gotten to break that cycle because in 2014, I remember that I was, I did private lending with JWB, had a great experience. And then I was like taking that money out and I was thinking, man, what do I do with this thing now? Do I re-up for private lending? do I just go in on a rental property right now, right, and hold it? And I remember just getting spooked because it was election time, and I just talked myself out of it. And I think back to what I could have done with that money back then, and I get really pissed at myself of just like I'd be in a completely different place, right? And we talked about this before the call as well, that I have this kid that I'm mentoring, and he's like writing some copy, and I just found the thing that he wrote, but he wrote me something that I found really profound. He said, you know, in 2020, it was too scary to buy real estate. In 2021, it's too expensive to buy real estate. In 2022, rates are too high to buy real estate. And it seems like every year there's an excuse, but instead of waiting to buy real estate and wait. I had never heard that, but I get the sense that saying is something that more experienced real estate investors have heard before.
Yeah, for sure. I mean, that's the age old adage, right? Hey, it's real estate is not. And if you talk to any investor on the face of the planet, everybody thinks, oh, we'll flip a house and make $1 million. And yeah, you're going to have some slam dunks, some home runs every now and then, right? But just like any type of wealth, real estate is learned or earned, and wealth is earned through real estate over time. And that's the play, right? None of us have a crystal ball. We don't know where the top is. We don't know where the bottom is. All we can do is rely on the rule of averages. And the rule of averages is that over the course, since the first house was built in the United States to today, the value has continued to climb. Has it had some hiccups, some trips, some falls on its face? For sure, right? But the crazy thing is, and here's just another stupid stat that we can throw out there, when a recession has not been based on the housing market, and a recession has only ever been based on the housing market once in the history of the United States, and that was 12, 13 years ago. Traditionally, in a true recession, right, if you're actually looking at what the true value of the piece of property is, not the inflated value, which we've been experiencing over the past, year and a half, 2 years, you look at the true value, right? Real estate only loses between 4 to 6% value. That's the correction that occurs, which is extraordinarily minimal, right? You hear all these numbers, 20%, these houses are going down in value by 20% or 30%. Well, that's because someone got real greedy and they decided, man, look at all these houses that are going for $50,000 over asking, right? Let me just list at $50,000 over asking. And then they have to lower the property price by $30,000 60 days later, just because they overpriced it, right? Like, that's not realistic, right? The original list price of the home that sold for 50 grand over asking, that's the realistic price, right? So be careful what numbers, you guys are reading, and evaluating, because it's not always the truth.
Yeah. That's an interesting set. I never thought about that, right? Like that it gets that stat gets inflated just based on like the arbitrary realtor telling you, no, let's sell it for all this, it was never really the stat. Whereas like, if you just think about it as you described it, the turtle, right? Like if you just think about the turtle concept, and that's always going to work. And if you're pricing it that way, it's going to work as well. You also said something in that wonderful rant that you started with of shorting the dollar. Tell me what you meant by that.
Right. So we have the luxury as real estate investors is to lock the cost of the dollar in for a term as long as 30 years, right? Through a 30-year loan. And, we can sit here and say, yes, interest rates are expensive. Right now, we're paying more for the dollar than we have in the last 12 years through real estate. But what we're doing is we're locking the cost of money in, right? As money in the future becomes less valuable due to inflation, right? We've purchased something for this amount of money that will only gain value, and our money is locked in at that value for the next 30 years, right? Whereas each day that moves forward, that dollar buys us less and less and less, right? But we've locked it in here, right? And what the amazing part is once you own an asset, that asset is forever a bank account, right? Where we can continue to short the dollar over and over again as we gain equity in that home through refinances, through whatever, right? So it gains value. We can continue to short the dollar. It's just this play on financing and our buying power that's unlike any other asset out there.
Yeah, Drew Barnhill is putting in the chat that he's been preaching that for a while, that it's the anti Dave Ramsey. Do you ever You ever buck up against that stuff? But yeah, but Dave Ramsey says XYZ.
Yeah, I mean, Dave Ramsey actually had. I heard a Dave Ramsey talk the other day, and he had, he's built this cult following, right? So he kind of has to like live by it, regardless if it makes financial sense or not. And he was having this conversation with a real estate professional about his office and kind of the compound that he bought to put all of his employees in, and he was resigned to paying cash for it because he had to, because he's Dave Ramsey, right? And he had to pay like 4 million. He basically said he spent every dollar he had to kind of buy this commercial building and this compound that he put all his, and he doesn't admit it out front, but you can see in the face, you can hear it in his voice where he's like, yeah, I could have borrowed money for like 4% and had way more capital available to build my business, better my employees' life, and like do all these things that realistically he probably should have been doing, but he kind of put himself in a hole. I mean, debt is not, just because it's called debt doesn't mean it's bad debt, right? If you can have debt that creates you money, that's how every billionaire on the face of the planet is built.
Yeah, totally. And that's, it took me like a solid like 9 to 10 months of like hosting the show to really understand that piece. So I think it's something that we can't ever talk about too much, right? Like the idea that what other asset class do you get leverage on? Like what other asset class can you, this 4.6% appreciation rate happens for the 25% I put down and for the rest of the 75% of the asset. I can't go buy like $260,000 worth of Apple stock and only put, I'm trying to do the math, only put $65,000 in, right?
Yeah.
And then gain that appreciation in any way. So I'm a big fan of that. John, what markets are you invested in right now, man? Where do you own rental properties? I know you have some in Jacksonville, right? Do you have in other ones?
Yeah, so I invest in 6 or 7 states around the country. JWB in Jacksonville is one of the places that I own properties. I own properties with the guys, and I have properties I've owned with them for 5 or 6 years. To be honest with you, they've never been vacant. Kind of crazy. So I guess we're waiting for that shoe to drop, but it's been awesome. And then I own properties where else? So Indiana, Indianapolis specifically, Arkansas, Little Rock to be specific, Tennessee, Memphis, Texas, Dallas, and I also invest in Connecticut, but that's because my family's back there. So not the best rental market in the world, but we make it work.
Yeah, you basically just went into like cash flow markets, greatest hits.
Exactly.
How do you differentiate between those markets, man? Like I love when I'm talking to somebody that since all my education comes from this, and I have this relationship with JWB. So far, I have 3 properties, they're all with JWB, but when you were thinking about the different markets and stuff like that, how do you think about like this property here in Jacksonville versus a property in Indiana right now, or a property in Dallas, stuff like that?
Yeah, I mean, there's what I would break markets into is cash flow markets versus growth markets, right? And like the Texas, the Florida markets, those would be my growth markets that I invest in, right? The value gain in the asset through appreciation is going to be way more significant than what I'm seeing in Arkansas or Indiana or Tennessee, right? In a lot of cases. So it's just like people think about, I think, most likely diversifying a stock portfolio, right? This is just diversification of real estate portfolio, right? There's some things where I want to see growth. There's some things that I want to see giving me cash flow. And that's how I break it down. That allows me to see best of both worlds.
So versus growth market, right? We talk about this a lot on the show, and I'm just curious, right? Like if you were to just take the jargon out, right? And you're just talking to somebody as a complete novice, what do you mean by cash flow market versus growth market? And what makes, like, who do I need to be, like, what am I thinking if I were to prefer a cash flow market, or I would prefer a growth market? Like, how would you steer somebody in those ways?
Yeah. So a little preface on this before I kind of share that is, for me, I invest with leverage, right? So I don't buy properties cash. So I invest with leverage, right? And I invest with leverage because 1, gives me the best rate of return, and 2, I'm not ready to retire yet. So I can use leverage to allow me to have more buying power, right? And pay the properties off over time. So that's kind of the framework of my investing strategy. And then from cash flow to growth, for me, growth markets is a long-term play, right? It's like set it, forget it. We're getting a little cash flow every month, but long-term play is to get 5%, 10% annual appreciation year over year over year over year. So this $200,000 house I bought, today in 25 years, it's worth $1 million, or, it's worth $500,000. Right now, I can decide, hey, what's the cash flow look like on it? Has the cash flow improved with the value increase? If not, great. What I can do is I can 1031 exchange that into something that gives me more cash flow, right? I can go buy 5, 6, 10 more properties in another market that gives me more cash flow. It's going to allow me to retire quicker, right? Because what allows us to retire? Cash flow. And then the cash flow properties in the other markets, I just like seeing big checks, right? There's this plan, like what happens if shit hit the fan tomorrow? It's great to have all these sexy properties I'm waiting to appreciate. But if I needed to, because I got injured or was in a car accident or needed to take time off or just didn't feel like coming to work ever again, right? Is there something that could supply me the cash flow I need to support my family, right? So that's the cash flow side of things. So that's how it's differentiated, if that makes sense.
Yeah, that makes a lot of sense, man. We talk a lot about cash flow today versus cash flow tomorrow, right? Like the idea of when is it that you need it, right? So like for me, the last property that I bought, I cashed out an old IRA, and luckily I did it in January, right? So like I cashed out this IRA before the market took a total dump and paid a 10% tax. That has been great for me, right? 10% penalty, right? But definitely way out ahead on it. And I put it into a property that is cash flowing me like $50 a month, but I'm in it for the long run, right? Like I looked at it as this was IRA money. It's not cash flow that I need today. It's cash flow I'm going to need tomorrow. I know in 25, 30 years, that thing's going to be cash flowing like $3 to $4 grand a month because rent's going to go up. My mortgage is going to get paid. It's going to be all positive. And then you, who's been doing this for a long time, you have kind of in both buckets, right? Like you have the cash flow tomorrow bucket, which is your long-term planning. And then you have the cash flow today bucket where you bought some properties that are allowing you to do this because you do this full time and you're making income from it and you're living off of it today. I find it interesting that you brought up a middle thing there. That is this idea that in your cash flow tomorrow bucket, you see options of, okay, well, if I do get in trouble, I can 1031 exchange a cash flow tomorrow bucket for a cash flow today bucket. Can you talk about that a little bit? Have you ever done that?
Yeah, absolutely. Great question. So, it's not so much about getting in trouble, right? Like, I will time to time over the years assess my portfolio, right? And let's say in 20 years, right, I've seen, I've gained $300,000, $400,000, $500,000 in equity in one of these properties, these growth properties, right? And maybe I'm getting closer to kind of hitting that retirement number. And heck, maybe it's a buyer's market like it is right now, right? Property prices are slowing and we're in a place where we can get better deals, right? I might just decide, crap, let me accept that $500,000 in growth. Let me take that one property, turn it into 6, 8, or 10 properties. And now I've just increased my cash flow significantly to allow me to get to my goal that much quicker or increase what my end goal might be in terms of cash flow for retirement. So, it's just, it gives 1031 exchange as an option, right? That's, just allows us to have more options for retirement.
Yeah, man, that's an interesting proposition. That makes me feel like I had never thought about that. And I'm like, oh, okay. Yeah, that's cool, man. So now even if I'm just like, cause I've bought my 3 properties in Jacksonville in the last 2 years. And if I ever get in a pinch, I know I can go 1031 exchange those into a lower cost, higher cash flow market if I really needed it for cash flow today. And I never really saw the buckets as interchangeable, man. So I think it allows, I don't know. It's like the pressure in the balloon is less of on the entrepreneurial journey for me.
Yeah. Well, you just kind of shared a pitfall of other investments, right? Is, we have a real asset that the federal government encourages us to own, right? Because we provide housing for other people. So they give us options to continue to grow our wealth and save on taxes, right? Yeah. You did what most Americans did and saved in an IRA and, at some point in time made the decision, this isn't the highest and best use of my money. So you had to pay a penalty. right? The federal government literally tells us, hey, you can sell this house and you don't have to pay us any taxes, and you can kick that can down the road until you die, right? So, I mean, there's an encouragement by everyone to own real estate, continue to own real estate, continue to grow your wealth.
Yeah, I love that. I love that. And you wouldn't be able to do that in another cash flow tomorrow bucket, right? Like if it, so it's cool, man. I really like it. I was going to ask something else. So as far as, so you're in other markets, right? You're teaching students that are in different markets. This price point, this IRR, where do you see it kind of like falling in like the range of other markets, right? Like I feel like Jacksonville has appreciated rapidly, but we
For
still,
sure.
we still call it a affordable market as far as it's still underneath the national median. How is this comparing to other markets of what you're seeing? Can you kind of like place it?
Yeah, for sure. I mean, Jacksonville is definitely still an affordable city, right? I was just there probably 6 months ago and was still blown away at, how much you could buy a house on the beach for compared to where I live in Southern California. So, and not have to pay any income taxes all in the same breath. So that's a beautiful thing. From a return standpoint, right, there is what's called active investing versus passive investing. And this is truly a passive investment. You just write a check for the down payment or for the property or however you want to invest it, own it, right? And if you look at your comparable other investments for that amount of work, right, of just writing a check or getting qualified for a loan, personally, I think it's like not even a comparison, right? Because not only are you getting 11.2% IRR, but you own a piece of property, right? Two things that, are hedging against inflation. And, from my standpoint, right, I trade time for money in regards to I'll go out and look for the property and have to buy it and hire contractors and manage a project and then get it rented and all those things. So, my returns on the active properties I buy and my students buy are going to be higher than this, but, they've given 50, 60 hours, maybe even more to a property, right? Whereas in this situation, you give 2 hours and get a double-digit return. So in the scheme of things, still super quality investment. It's just what's important to you, right? Is it time? Is it money? Is it return? Is it experience? That's risk. So yeah.
Yeah, that's a good conversation of like active versus passive, right? So these days you're selling the education for how to do this in an active way. JWB is selling just the asset of having this thing. I know that from JWB side, the conversation when it comes to making these decisions has heavily been, why would I buy this today versus in 6 months from now?
Yeah.
I'd like to kick this from both sides, right? Like from that angle, if you're going to be a passive investor, why buy today versus 6 months from now?
Yeah. I mean, the argument is, just we continue to go down this road of when's the right time to buy real estate, right? Here's the truth of the matter is if, you've never bought in a property before and you're trying to sell me and you've wanted to buy a property for 5 years and you're selling me this thing that you're going to buy a property and wait 6 more months, right? You're not going to buy a house ever, right? Because there's always going to be a reason why you shouldn't, as you had mentioned earlier, right? Interest rates are still high. Oh my God, the prices are going down. We're not at the bottom yet. Let's wait another 6 months. And 12 years goes by and you just lost 12 years worth of value, right? So, number one, if you've never bought in real estate before, just don't even pay attention to what's going on in the market. Just make sure the asset is a quality asset that's cash flowing for you and just buy the damn thing because that's all that matters, right? And then number two is if you are an experienced investor, right, you're not asking those questions, right? Because you understand the value of owning a piece of property regardless of what's going on, right? You come on this call, you talk about, oh, so-and-so just bought 3 more houses, right? Well, that's because they understand the value that JW brings to the table. And this is a set it, forget it investment. They're beating inflation. They're getting double digits returns. Like they're looking at themselves going, I could invest in the stock market and lose all my money right now, or I can get 11% return on my money, regardless of what the value of the house is, right? So, I mean, that's the difference.
Yeah, it's where else are you gonna, if you have money, you're looking for a passive investment. You know, like where else are you going to put it right now, right? Like you can wait 6 months for inflation to eat at it. You can wait 6 months for prices to continue to go up and interest rates to go up. You don't know what's going to happen in 6 months, or you can start being part of the American dream.
And I think one thing that you just mentioned, which just clicked, I didn't think about it, is, you know, there's an inverse effect between the cost of real estate and the amount of inflation we're experiencing, right? And what I mean by that is, as the cost of real estate goes down, the ability for your dollar to buy things goes down as well. So in your mind, you're like, oh, real estate's getting cheaper, I'll just buy it when it gets cheaper. But what you're not seeing is that your money buys you less. So even though the property prices are decreasing as inflation increases, right, you're not saving any money by buying a property that's worth less in the future because your money's doing less, right? So that in itself is just, you know, you're just chasing your tail.
Yeah. Well put, man. What about doing it yourself, right? Like, I'd love to give you an opportunity to answer this. Like, if I'm thinking, all right, I'm going to invest in a program, in 90 days, I'm going to lock up my first property. What is stopping someone from saying, why don't I wait 6 months to do the program to figure out how to do it myself?
Yeah, I mean, a few things there. One, you know, the reason why I designed the program was for people who are in a position that, you know, maybe they don't have $70,000 laying around to buy a house from JWB, right? But they still have the desire to make a change in their self and their own family's financial future, right? And people think in their mind, you know, I need to buy 5, 10, 20 properties. I mean, 1 or 2 houses, you can change the course of your family's life forever. You can pay for college, you can pay for, you know, extenuating, you know, care at a certain age and your health.
I feel that way. Having bought 3 in 2 years, I tangibly feel that I've changed my financial future in the sense of like, dude, in 30 years, like, just these 3 houses are going to make such a big difference, man.
Exactly, right? You have an asset that you can maybe leverage again to pay for its college. You have an asset that you can leverage to help pay for long-term care if you or anybody else in your family ever needs it, right? You have just this constant bank account you can reach into, which is beautiful. And, you know, 2 things. One is when you join any type of coaching program, right? You know, just because I paid to get a coach doesn't mean I'm instantly a master, right? So now's actually the perfect time, because in 3 or 6 months, you're going to be really damn ready. Like, you know, when we really start to see a price change, right? So that's number one. Like, you know, I'd love to, you don't jump into the boxing ring with just because you signed the waiver form, right? You jump into the boxing ring after 6 months worth of training, right? And that's where we're at right now. It's like, let's get in the gym, let's train up, let's learn, let's see what the market, let's figure out what market we're going to invest in, let's get our private money lenders and our contractors and all these things lined up. And now we got everything, we got a whole team behind us, the Avengers are here, and now we can strike while the iron's hot, right? I mean, that's just common sense, right? And I go back to the same thing. You know, every person that I've ever potentially worked with as a student who wanted to get into real estate investing and said, you know, now's just not the right time, I think I'll be in a better position next month, never does it. No one's ever called me back. No one said, now I'm ready, right? Life got easier 45 days down the road. Like, that's never going to happen, right? So, you know, you either do it or you don't, right? And that's, you know, that's the mentality of the student.
I like it. I like what you said, right? Because we talk a lot of, you know, again, we're talking passive investments a lot on this show. And while who knows what's going to happen with housing prices, we expect from the passive investment side, from the ability to buy off of a reputable, vertically integrated turnkey provider, there isn't really going to be deals to be had because that inventory stays, you know, within their portfolio until it's ready to sell. But from the active investment side, can you find a foreclosure? Can you find somebody that's hard up in these economic times and make that extra margin because you're putting the work in to find that absolutely in? Will that probably start to happen in the next like 6 to 12 months? Makes a lot of sense. And it makes a ton of sense to, if that's what you're trying to do, why don't you right now go out and try to find deals and go through that iteration so that you are a true master during the hardest economic times. When it's all going to happen, you found your team of Avengers and stuff like that. I love that, man. I think that's a really
And it's already happening. I mean, I have, I would say the vast majority of my students right now have rental properties under contract that they've found within the last 2 to 3 months, right? And I'm talking zero marketing budget. I'm talking never owned a rental property before in their life. I'm talking came in, learned the process, used the resources of where I find properties each and every month for free, and just started making offers, right? And they're buying houses 2,000-3,000 miles away from them that, through a little bit of work, a little bit of construction, right, a little bit of renovation, they're going to have the ability to buy homes, killer cash flow, refinance their money out, and just put themselves in a great financial position, right?
Yeah, man. I see it as myself as a passive investor. I'm pumped that I got in when I did, because even if there is deals in 6 months, I now have that equity that I built into my home that is available to me, all that stuff, man. I think that's a great answer. All right, man, let's jump into a little bit of Q&A here from the community. Ken Moline, the patriarch of the first family of the Not Your Average Investor Show, is asking, this isn't so much for you, John. He's saying, Madison, can you include in today's program a quick overview of the hurricane that swept over Florida last night on the Jacksonville area, specific JWB properties? Ken, I can tell you that Madison was just showing me the outdoors in Florida, and it's in Jacksonville, and it's really, really nice. I don't really think it's hit Jacksonville full frontal yet, but Madison, I don't know if you have any kind of data there.
Hi, everybody. It really isn't bad right now. The only main concern that we've been told to watch out for is like storm surges, and it's pretty windy. But other than that, JWB properties aren't like rare occurrence in flood zones. So that's not something you guys would have to worry about. It rained for maybe an hour this morning. We'll probably get a few more bands, but I think the bulk of it, from what I've been hearing, is basically over. Just some wind. I can show you guys the outside if you really want to see it. It's really, really not bad. So hopefully this settles your nerves just a little bit. As always, JWB is on call at all times. Your CRCs, portfolio managers are reachable. Everybody's remote right now. We're returning back to office tomorrow. Vendors are on standby. I don't think there's very much power outage. So it's been a breeze. We've been very lucky.
It's been a breeze. I like that.
Literally.
No pun intended. Great. Thanks, Madison. And yeah, a couple of things to note there, Ken. No news is good news when it comes to this stuff right now. So if you haven't heard from your portfolio manager, nothing's happening. And 2, I'd feel remiss not to state this idea that JWB kind of like lives for this, from the way that I understand it, right? The fact that they are the 10,000-pound gorilla that has an army of contractors that, they spent a lot. I think, what is it, like $7 million a month or something like that in construction contracts and in maintenance stuff. So right now is, if there's something happening, you're going to get the best team made out there from whoever the contractor is, right, Madison?
Absolutely.
Cool. All right. A couple more questions here. These ones are for John. Eddie Harris from Eddie, I heard that you're going to be at Fortune Builders, man. I just shot you a message here in the chat. If you want to connect, I'm here, man. I would love to talk to you and get to know you. But he's saying, Eddie is saying, hey, John, great to see you again. You started my wife and I with our first few properties with JWB. We are doing a hybrid type of investing, which includes syndications. What is your thoughts, and appreciate your knowledge? Eddie from Atlanta. So I guess he's asking, what are your thoughts on this like hybrid type of investing, including syndications as well as rental properties?
Yeah, and I was actually going to mean to bring this up earlier. I'm glad, Eddie. Good to see you. Thanks for bringing this up. I'm glad everything is going well with your investments. I mean, we invest in what we know, right? And for me, that's real estate. So I diversify as well. I have money in probably 4 or 5 syndications. I own turnkey rental properties with the likes of JWB and a few other turnkey providers. And I go out and I buy, properties that I renovate and hold as rental properties, right? So we're doing all the things just because that provides us additional control. It spreads our risk. And so, I mean, if you're comfortable with the investments, Eddie, or anyone on this call, then make them, right? Just don't make an investment that you're not comfortable with. That's, regardless of how good it looks on paper, if the hairs on the back of your neck stand up, that's for a reason, right? So don't allow the numbers to cloud what would be better judgment, if you will.
Awesome. Great answer. Eddie, I hope that I got to meet you here in Vegas, man. I heard you here. So, all right. Pedro Nacianceno asks, Pedro, good to have you back, man. I haven't seen you in a while. He asks, I noticed the house is close to a railroad. Is that a concern at all? Noise, maybe? I'm late. Sorry if this question was asked already. I'll give you some time, John.
Let me hit this. So this is the
Please.
best. Like, I love this. This is probably one of the biggest questions I get from, it's on a main road. It's by a railroad. It's across the street from a shopping mall, whatever, right? Here's the deal, right? If you're going to move into the house and raise a family there and it's going to be yours, right? You know what? Maybe that's not your gig, right? But remember, you're not buying this house for you to live in, right? You're buying this house for someone else to live in. And the people that are renting a property are not in the same mindset or position that you are. The most successful rental properties I've had have been in industrial areas, on main roads, across from malls, gas stations, all these things. You're like, John, what are you talking about? They must be in the urban core or something. Nope. They're just strategically placed in high traffic areas. So whenever a for sale sign goes in the front yard, guess what? Everybody and their mother in town sees it, right? So all these things are benefits, and put things like houses, like you ever see a beautiful neighborhood and there's all these houses in the interior and there's one row of houses on the outside, right? And you're like, man, why do they sell for so much less? It's because the highway is right behind them, like in their backyards, right? That's like you get to buy the cheapest house in the nicest neighborhood and turn it into a rental property, right? Like that's rock star status. That's what we want. We want to find a property in the nicest neighborhood that's deficient for some reason because there's a railroad in the backyard, and buy it because people still want to live there.
Love that, man. Yeah, we talk about that a lot on the show. This idea that don't make an emotional decision on these homes. You're buying them not for you to live in, you're buying them for other people to live in. And as a renter, it's a very, very different equation, right? What you said is great. This idea that you get a good deal because you are in the nicest neighborhood you can get, you're getting max ROI on your money is a big deal. And then at the end of the day, whatever that price point is, or whatever the reduced, the lower rent or the lower price point of the house, because it is on a railroad track, it's already priced into this evaluation anyways, right?
Yep.
So yeah, that's a great one, man. Well said. John, I think we're good here, bud. Your triumphant return was awesome. The interaction in the chat was great. We had 36 plus people here this whole time, taking a day out of an hour out of a Thursday work week and spending time with us. That never goes unnoticed to me, that the community keeps on showing up. You keep on finding value and being here together with each other, adding to the conversation, making it easy for us. John, give us again where to find you if somebody does want to go the active route and they want to take this course. Where do we send them?
Yeah, I highly recommend that you pop over to my Facebook group. Just pop in there and take away as much value as you can. I mean, there'll be really easy ways to reach me and contact me if you want to go down the coaching route. I'm going to drop the link in to my Facebook group in the comments here if you don't mind. Is that cool?
Yeah, 100%, man, 100%. I wrote the name when you first said it, but I don't know if I wrote it right. But a link is even better.
There's the link.
There it is.
Should be in there to everyone.
Cool. And just if you're listening in the podcast, it's facebook.com/group/rental property pro. You can find.
Yeah. If you just go onto Facebook and just search rental property pro Master Burr Investing, you'll be right there. Master
Burr. Is that a Burr with 4 R's or 5 R's? What is that?
4 R's, the 4R version.
I never know. All right, John, man, I really appreciate you doing this with us again, man. Like, it's always, I love picking your brain about this stuff because you're so well spoken. You've done so much of it, and I really get to enjoy this stuff, man. So you are welcome back anytime, my friend.
As always, appreciate it, man. Love to come back anytime in the future, and you guys have a kick-ass rest of the week.
Love it. And on Tuesday, what we're doing, right, when I'm at a conference, when I'm here at Real Estate Ignite, I go crazy making friends, right? So like I'm in a room just making as many friends as possible. And what we're going to do is the most interesting people, we're going to have them on the show next week to give us a people's history of what we learned here at Real Estate Ignite with Fortune Builder. So Tuesday's show, we're going to bring a bunch of people that are here at the conference to tell you what they learned, to tell you what they saw. It's going to be an awesome experience. I've done this on my own shows in the past. This is the first time we're doing this on the Natural Average Investor Show. So I hope you all join us on Tuesday. I thank you for being here. And remember, if you don't want to just sit there and wait, you want to get in and have real estate work for you, you can't think like an average investor. See you next week.